Hey everyone. I actually meant to drop another video sooner, but I got a bit tied up with some other things on my end. But it worked out kind of nicely because when I last spoke, I was showing you a chart of Amazon, using Amazon as an example, and I was talking about how generally I think of it as a stock that tracks well, tends to go up, and the example was if you had the price at 236 or $230, what I could sell a put option with a lower strike price, and I used 190 just to make the point. And the rationale was if I sell a put option expiring 30 days from now, so we have a 30-day runway, then what I feel comfortable that the price of Amazon will stay above 190, and that it wouldn't drop about $40. And if it were to drop, could it drop that far? Could it still recover within the 30-day period? And then actually looking at Amazon just now, it actually presents a good example here. And then actually I got a chance now to look at Amazon, and actually there was a drop pretty soon after I did the video. It dropped from roughly around 236 or so dollars, and it fell down to about 210, roughly in that neighborhood. So it did drop, not all the way down to 190, but it dropped, and then after it dropped, it gradually over the next few days made its way back up. And so that's kind of the general point I was making, which was even when stocks drop, at least the stocks that I'm looking at, which are generally blue chip, generally stable, not so it didn't drop. So had I sold a put option at that lower strike price, I would still be safe. I would still be able to avoid assignment so far. I mean, sure, anything could happen after this, but from my experience, most of the time when I'm selling a put option, this is the behavior I see with stocks. Now I'm going to show you a bit about what I'm actually looking at when I'm actually going to make a transaction. So looking at, this is the options chain. You see calls on the left and puts on the right. So I look for a few things sort of in order, right? First is I've already figured out what stock I want. That's the ticker. Next is I'm looking at what the expiry date will be. And you can see that in the top row, the different dates up there. So I'm zeroing in on September 12th as an expiry date I would look at. You'll see the same view for every single expiry date, but the pricing of which we'll talk about now will be different. So here, looking at calls, looking at puts, for the most part, I'm looking at puts obviously because I'm looking at what put option I'll sell. Now you can kind of see in the black marking in the middle there, that price 224. When I took the screenshot, this was the price of Amazon. And then you can see the strike prices for the different contracts in that middle column. When the price is going lower, you can see higher up the chain, and as the price increases, you can see further down the chain. Bids and asks, which I think are generally self-explanatory. You have people who are interested in buying a put option, they're putting in their bid. People interested in selling put options, they're putting in their asks, and then you see the spread. And then other investors who are just buying and selling off of those bids and asks, right? By the time I'm selling a put option, I already know I want to sell. I don't typically get nitpicky about the spread and thinking, okay, I'm gonna let's use 200 as the strike price, because we're looking at the chart. Maybe that would be where I think the price will be above by September 12th. So you look at there's 59 cents, 61 cents. I'm not really going to nitpick at whether or not when I sell the put option, I'm selling it at whatever price there, because for the most part, that's just, in my view, just nickel and diming the trade. I'm not trading in high enough volumes that kind of difference is making that kind of that delta is a huge difference to me. I'm just more interested in getting in the position, and if getting in at 59 cents is not if I'm starting to look at the difference between 61 and 59 cents, for me, I would just not even get in the position. So what I tend to do is I'll probably put in ask if there's a spread like that where there's a middle 59 or 61. I might put in an ask in the middle of the spread, like at 60 cents, so I get a few extra bucks. Or like if it were at 205, I might put it in at 94 cents, right? And if you see some spreads that might be big, like 10 cents difference, I'll put it in the middle, or I'll try to get it closer to the ask, as close to the ask as I could. But when it's more important to just get into the position, because once the prices of the stock and the options start moving, then the bids and asks are all just going to shift together, and I'll lose my chance to get into the position altogether. Now, a bit about the notation, which throws people off a bit. I mentioned each contract is 100 shares of the stock, and when you look at that bid, it says 59 cents. That's per share in the contract, and 61 cents per share in the contract. So if it's a contract, an Amazon put option strike, $200, and then expiring September 12th, then I might put an ask out for 60 cents or 59 cents. What that means is it's actually $60 or $59 I'll collect in option premium in cash that come to me from the buyer. So I'll collect $60. The other person gets to hold this contract. Now I'm obligated. That my obligation now is if somebody, if before September 12th or by September 12th rather, the price of Amazon has fallen below 200, the holder of that contract could exercise it, force me to buy their Amazon shares at $200 a share, 100 shares. So I have to have my $20,000 ready to buy those shares. So that's how to read the options chain. Looking at another week, for example, if we go 1 week earlier, September 5th, and let's look at the strike, $200. So you can see that with an expiry date 1 week earlier, it's cheaper. If we were to look at an Amazon put option with a strike of $200 expiring August 29, which is 2 weeks earlier than I was just looking at, it's even cheaper. The idea is time decay is a factor in the pricing of put options, which makes sense if you just think practically speaking. The more time he has on the contract to force me to buy his 200 shares, the better it's fair. The more time there is for the price of Amazon to fall below $200, right? If he sells me the put option, if he were to buy the put option from me, like that's expiring in 2 weeks, he has less time to exercise it. That means that he's not going to want to spend more money when he's only got about 16 days. But if I give him 30 days, he might be willing to spend more money, right? So that's the idea behind the time decay for the options, and why when you go look over each week, you see the difference in pricing there. If you think about this, if I sell that option, it's expiring September 12th, and I've now collected $60. Let's say 1 week goes by. That means, using these examples here, the prices of the options, okay, assuming different things hold, like the price of Amazon stock is sort of moving sideways over a period of time, assuming that there's no kind of significant economic events affecting the overall market or Amazon, nothing materially affecting Amazon in that time, just assume it's just a generally moving sideways stock, the price of those options will be decreasing as each week goes by. That's a general rule of thumb. So if I were to wait 1 or 2 weeks, that $60, that option that I sold that was worth $60, now it's going to be worth, let's say, roughly $20 or $30. So now I'm holding this option that's worth less than what I sold it at. I can go on the market, buy the same option back, the strike 200 expiring September 12th for, say, I'm just making it up, what it'll be. It might be $40, right? I could buy it back at $40, which means I would have sold at $60, bought it back at $40. It means I'd have $20 extra cash by the end of these 2 trades. So that would be a 30% win, right? So by and large, that's usually how I'm transacting. I'll get into a bit more specifics about how long I want to hold and how I'm deciding where I'm entering, but that's the general gist of how it is that I'm building that realized return. I'm just like pulling in cash each month by selling put options. Like you can hold it all the way to the end of 30 days and collect all the $60, right? Just keep it, all of it. But the reason I typically don't do that is because we just used the example where Amazon just dropped, say, 10% in a really short time span. If I were to hold it full 30 days and then in day 27, day 26, it's now fallen 10%, I'm not so confident that in 4 days that price is going to go back up, assuming that if it's fallen below my strike. If it's fallen and now it's at 205, I'm still safe. But I prefer to avoid putting myself in that situation just for the extra remainder of that $60. I could just buy back the option, take that cash. I've made money off of that trade. Now I can look for another opportunity to sell another put option, whether it's on Amazon or another stock. So what I try to do is I actually just try to minimize how much time I'm actually holding options. I try to sell, I try to grab what would be a 10 to 20% win and then keep the cash. If I can minimize how much time I'm actually holding options, I'm reducing the chances that I'm gonna get assigned to have to buy someone else's stock. Usually when I sell put options, it is somewhere between 30 and 45 days out, because the idea is if a stock were to fall, make a big fall, like say 10%, over a 30-day period, a stock could at least climb up, even if it's just a few percent, to climb above the strike price if it were to actually fall below a strike price. Yeah, I hope that helped. Let me know if you have any questions, and I'll talk to you next time.